Hey everybody, Michael Martin. Thanks for being here. So someone asked if I could show graphically what does it look like when you adjust your stops and you're trying to achieve like an asymmetric return several times your R, 3 to 1, 4 to 1, 5 to 1, this and that. And I think like it was pretty hard to come up with an idea because when you're entering your orders, they're just lines like buy, sell, this and that at your stop price, and then the price goes up and then you adjust it. And I kind of did that on the channel. If you go to the live tab and you can see a replay of a live stream that I did where I talked about incremental exposure and how you can adjust your stops on the fly. But I did come up with an idea of, how can I put this together and show you a graph of what it would look like from like a histogram standpoint. And so I want to share that with you right now because I was able to put something together. Boom, let's go screen. This is my first time trying to share the screen here. How was that? Can you see that? So now let's take a look at, first of all, what we're looking at. You're looking at number of trades here on the left side and the y-axis. And then you can see percent return along, the y-axis. And first thing you notice is that in terms of break evens to tiny paper cut losses is the number one column in terms of distribution, right? So this is like you put your trade on, you're risking, say, probably 1/4 of 1% of your account. And as you would expect, more than half the time you're getting knocked out for, small paper cuts. Then, a couple times maybe it jumps through your protective stop, or you've adjusted your position size because you have a different type of a setup that has had higher expectancy, right? So there's not a lot of trades here, right? So take it with a grain of salt. But then you notice, like, as the market starts to move, you start to make more money in and how you trade, and you adjust your stops accordingly. So what ends up happening is it's hard to pick the top. You can use reversals for sure, like Victor Sperandio's 2B reversal can be handy. But most of the time, you're trailing with a percent base or a price base stop, or you're trailing structure. And so whatever it is, in my own trading, I tend to let them run because I don't want to get into trying to guess how high things can go. I have a pretty good feel, but at the end of the day, I like to be surprised. I don't want to assert my, I don't know what the word is. I don't want to say ego, but I go to bed at night knowing that people are not that great at prediction. And so I include myself in that pool of people. And again, I feel like I have decent instincts. I feel like I can trust my instincts. But what I tend to like to do, and what I've seen over the course of my trading, is that sometimes the things can move far beyond where you think they can go. Now, sometimes they might go up and stall and go sideways and then kind of take off again, and you might have to deal with a little bit of a drawdown in a winning trade, give a little bit back in order to stay in the trade, right? And that was what I was trying to demonstrate here, is that even for swing traders, right, not day traders, because they're really just kind of offsetting everything inside the same day. If you're a swing trader and you can let things go for a couple of days, and you're just using like trailing structure or trailing a price-based or a percent-based stop, this is what the distributions could look like. So the best way to start is like, look over here. Here's one that's 4.25 to 4.5% rate of return on the account, right? So that's an outsized gains. If you divide that by, where the majority of the losses occur, that's many, there's an example of many multiples. But here's the thing, truth be told, it probably could have been all the way up here where you might have been able to offset if you looked at, a market had gone parabolic and you adjusted your stop accordingly, or you took a discretionary trade in the middle of the day. So when you see the green bars, you could skew the thing, maybe up another quarter to a half of where the trade actually existed in real time. And they all came back and were stopped with a trailing protective stop, and this is where they settled. Does that make sense? It's harder to do on this side because, you put your protective stop in right away and you get knocked out. That's just the way that it goes. So for progressive exposure or a smaller type of a deal, you want to add to your winners and then adjust your stops and then let the market kind of take you out of the trade, because no one can really predict how far things can move, whether it's a stock or a commodity, right? The thing can just haul and really, really go, and you're just ringing in the cash register. The thing that you have to get used to is the uncertainty that goes with doing that. In my experience, the profitability of my trading really changed to the upside when I stopped obsessing about my P&L. And that was difficult to do because I needed to make the money. That was my goal. I needed to make several multiples of my account because I was broke. I had, virtually no money. When I say broke, it means like I could pay my bills, my credit didn't get wrecked. I just didn't have a lot of breathing room. Some of you might identify with that. And, I've told the story a million times. I started with the equivalent of what would in today's dollars would be about $13,000. So I know there's some of you out there right now watching who are just starting that might even have more than that. So just think about, like, if you were, I don't think you could post margin on an E-mini and take it overnight. Maybe with some of the day trading rules, you can post a couple $1,000. But I really had no room to breathe, and that put a lot of pressure on me because I could not figure out how to divide up my cash and take advantage of directional moves in either stocks or futures, because I figured they would give me the best rate of return for the risk that I was willing to take, especially with futures, because the notional value was much higher than what I could get by buying a put or a call and getting that type of a notional value. Plus, I found it very difficult to understand all the Greeks and in the implied volatility, and I wanted to make more money sooner. I would eventually learn options and get good at them, but at the beginning I had to make a decision. Foreign exchange was easy for me to omit because I didn't want to be looking over my shoulder 24/7. Two, it was fantastic. There was no mobile technology and there wasn't any internet. So you can imagine trying to trade markets that trade 24/7 with no access. Some of you panic when you don't have your phone on you, or someone sends you, a text message and you don't get back to them within 30 seconds, right? Can you imagine trying to trade interbank foreign exchange, the actual crosses, with no data feed? So that was an easy one to admit, or to do away with. Options I found hard because I had a sense of the direction of things, but I didn't know how to buy them, right? I knew I didn't care about selling options because I didn't want to post the margin, tie up all the cash, and then know what my max gain was the day I put the trade on, right? Options trade T+1 or whatever. So at least they did then. So to me, it was like, okay, directionally, I can get in and get out, make a call, and go with it that way. Then use the trailing stop aspect. So like I said, all of these gains might have been bigger on paper in real time, but when the dust, when the stops get hit, you get knocked out and the number becomes definitive. And I think that goes part and parcel with trading, and then also trailing, structure, or trailing with a percent or a dollar-based stop. Some people just like to risk $1. Some people like to risk 50 cents. Make $2.50 for 50 cents risk. I get it. It's all legit. I've seen it work all the time. Furthermore, I think it's okay if you vacillate between, trailing structure and trailing with a price or a percentage-based stop, given the prevailing chart pattern, you see, because things change over time. And you get to, because to me, it's the same dollar value, because I would adjust my position as the volatility changes and the shape of the chart changes. I might trim a contract, I might add a contract, maybe coupled contracts, a couple of shares to adjust for volatility so that I could stay in the trade. But I would typically want to stay in the trades. I don't do the 2-for-1 thing and then free roll or just roll, let the profit piece run. So that would be like buying a call at 2, it goes to 4, right? So it doubles, then you sell half your position and you let the rest go because then you can't really lose. For me, when I was looking at longer term trends, not swing trades, I was always looking at yearly highs or multi-year highs or all-time highs. And when you get to all-time highs or 10-year highs, there's nothing but clear blue sky. There's no overhang. There are no trapped buyers like at all-time highs. So there's nothing but clear blue sky. So the last thing that I typically would want to do is sell part of my position just to have a feel-good trade. Remember we talked about go back and watch the episode, do the hard thing. Now, with that, I will have a lower win rate. But emotionally I'm okay with that. Some people aren't. So again, it's not to say one's better than the other. You have to trade your equity curve. You have to trade your own personality. It's very difficult for me to be you and maybe for you to be me. But I just thought about it like, okay, from an emotional intelligence and neuroscience standpoint, if my goal is to amplify my cash multifold, and I'm not talking 20%, I needed to make several 100% so I could dig out. Because when I started, my account was so small. Like again, today it was, if you adjusted for it was like 5K in the late 80s, adjusting for inflation at about 2.9%. Since then, you're looking at about 13K in today's dollars. So there was no room to breathe, and I thought my account was underfunded, right? Because most of the people who were opening accounts to trade futures, to give you context, at my firm had to have 100,000 liquid. I had about not even a fifth of that. I had about a little more than a tenth. So there was no room to breathe. And I needed to set myself up to win. I needed to set myself up to grow my cash without taking stupid risks. So that's why I had the progressive exposure aspect, and I learned to let my winners run. Because by removing risk with that 2-for-1 trade, the thing could be scoring into like 5-year, 6-year, 10-year, 12-year highs, and now I'm underfunded. So then what I did do, when there were moments when the market would go parabolic or it would race, and I'd have to guess and say, okay, if the stock went on a campaign, and I look back at history, which may or may not even help you, but I had nothing else to go on. What was the typical campaign? If the stock or the future contract had moved, say 5 to 10%, over how many days would that happen on average before there was a bit of a pause and maybe a pullback or a little wave of short-term profit taking? What would that look like? So I had that all worked out by every commodity. Stocks are a little trickier because you're dealing with large cap, small cap, mid cap, and then, also the share prices. So that was a little harder to do because, again, there wasn't any internet. I was doing it all by hand. So all I could do is like try to think my intuition. Now you have all these platforms where you can go in and add your data, and you can run scans and back test. Like none of that existed. Whatever back testing you wanted to do, that was all done by hand, or you were in Lotus 123, which was, like I've said before, the prevailing spreadsheet of the day. So it was good though, because it forced me to look at the numbers. Like I think one of the problems today for people who are reading charts is that they don't have a connection to what they're doing because everything's electronic. That's why I advocate taking out a notebook, and it could be a spiral bound notebook and a pen, and write stuff down. This also helped me because I was a visual learner, right? So once I wrote it down and took it down as a note, just like I was in college, it really helped me learn stuff. Of course, you can tell me something and I can hear it and I can remember it. But if I really want to lock something in, I have to take notes, which is why I have 45 notebooks around my desk for the various things that are important to me. Because once I write it down and I meditate on it, I can go back and read it, right? And they say a short list is better than a long memory, right? It's kind of cliched, but that really works for me. Because then I get to culture the pearl and say, okay, this idea looked good. It felt good in my head, but writing it out, it looked okay. But now over the past 2 weeks, I haven't really been able to evolve it. Where's the slowdown? So I would do that with the trading and say, okay, this stock can move between 5 and 10%. It'll pull back to be plus 7.5% up from the breakout, and then it can continue. And that's kind of how I built my models. Was what would I do if the stock went to what price? So it never occurred to me to want to decrease my risk in the middle of a campaign, because I felt, although yes, it would, when you take winners off, you lock in a winning trade, right? So it does skew your winning percentage higher. But I learned that once I learned that this was a game of expected values and mathematical expectation, I just knew them because I was a math kid, as a math whiz, I knew how to calculate all these numbers in my head. It was easier for me to stay with my winning trades longer, even though I knew my win rate would go down by doing it that way, because the expected value was like 25% higher. I'm pretty sure that's what the number was, and to me that was material. If it was 2%, then of course do the 2-for-1 trade, because there is an emotional reward for being able to say, like, okay, like people do with real estate. They put $200K down, buy $1 million house. House goes to $1.2 million. They finance out their cash, and then they go plunk it down on a new piece of property, let the tenant pay the mortgage on that. So I understand the mindset of, buying, options, especially, at like say you buy a $2 call and it goes, even if it goes to 3.5, you can take your original investment out and then let your unrealized gains go. And if it goes down against you, the worst thing is that you've lost whatever upside that you had if you have enough time. So I was aware of that trade. Like, it's not anything necessarily new, and it makes a lot of logical sense. I think it feels good also emotionally, but again, you have to know what you're doing it for. What would I care about making $400 on a $13,000 account, again, in today's dollars? Do you see what I'm getting at? Like, it feels good and you can figure out the percent, and maybe that matters to you, but it just never mattered to me. Because when I was doing it, for example, in today's dollars, I needed to make 10%. Like, that was what my goal was, to make 10% of my account on a trade. When you have smaller account size, it doesn't seem terribly unreasonable, right? You can buy a $1 call, it goes to $6, and there's your $500. Because I knew I was going to lose, I also knew that the commissions were material, right? You have to remember, and I've been through this a million times, with $5,000 then, round turn commission plus the spread was 1% of my account, $50. And that was if it was an eighth in, an eighth out in terms of commission, with at least an eighth to a quarter spread. So there's my 50 cents round turn, which is 1% of 5K, right? So you can imagine, if you're in today's dollars, if your round turn, because commissions are nothing, but imagine again, a dollar equivalent 5K in 2025 dollars is 13,000. Imagine if the spread and the commission in and out was $130. You'd feel very differently about taking a $250 winner and feeling good about it, right? Because you're also taxed, right? Even though, so you're 130 in cost, you pull out 250, so you're net 120, but now you're taxed. And I'm like, well, I had my day job. I couldn't be that active if I was even going to be so lucky. So I learned to trail structure and use percentages and say, okay, what was the better trade? If for example, I was trailing with 50 cents, but there was really strong support at 60 cents, I might trim my position to hold the trade longer, especially with the futures. With the stocks, I might tend to let it go, because the 10 cents was basically an eighth, right? An eighth is 12.5 cents. So if it was that tight, I would probably just let it go. But at the same time, you always have to define your risk and know, like, is it going to be structure? Like, where can you improve your exit? That's how you know which one to use. If the market's going on a 45-degree angle and there is no structure, then you can use prices or percent-based. But either way, it should be the same dollar value. You see what I'm saying? That's the way I looked at it. It was like, what would get me the best exit? And then if it really went into this tight range, like if it went into a 50-cent range, right? But I had been adjusting for like $1. Now I might be actually able to add to my winner at that point, because then where's my risk? My risk is, I puke out the whole position. I don't scale out. So that's what it could look like, the histogram. So I wanted to show you this so that you could imprint it in your brain and say, okay, you know, big deal. You have a lot of the greatest amount are basically break evens to, because this is 0 to a quarter point, right? So think about it. A quarter point every four points is basically, 1 percentage point plus the break evens. Like, so that is actually a good thing. It shows you that you're taking a lot of small losses adjusted for the percent of your capital. And then as you scale in and you let your winners run, you might see like, okay, these are bigger wins. Like if you win 2% of your account, so imagine having 100,000 and risking $250, and you have winners over here that are upwards of 2K. That's 8 to 1, right? So I think it's doable because we don't know what's going to happen ahead of time. All you can do is adjust your stops, right? And then from time to time, you will get on some of these names will run afoul. Not run afoul, that's stupid to say. They will run away from you to the upside, and then you don't have to worry about anything other than adjusting your stop, right? And I think what happens is, for some of you, let me go back on camera, stop sharing. There I am, back, same guy. You don't trust the process because you haven't seen it, right? You haven't seen that black swan, if you will, the outlier move to the upside, because you haven't given it a chance, and I don't think you believe in it. But in order to achieve anything, if you look at the neuroscience of stuff, you have to be able to see it in your head beforehand and believe that, you're worth it, actually. You don't have to throw around size. Like some of you might be throwing around size intraday. It's kind of typical, and also, there's nothing new there. But you can adjust your position sizes much smaller so that you can take the risk home overnight over the weekends. And what would happen if you had a 10 to 1 payoff with, like, if you were risking, say, 1/10 of 1%? Sure, you're risking $100 to make 1,000. All you need to do that once. All you need is to have that happen to you once. And you're like, okay, I see what he's getting at now. Again, if your goal is to amplify your cash, I think what happens is, because of social media, is you look at these guys and they're like, yeah, I put on the trade, it went here, I took it off, I got my winner. And I'm not gonna call their girlfriend ugly, right? Because it's not like they say you can't go broke taking a winner. That might be true, but you shouldn't be worried about going broke. That's not the point, right? Because you can position size yourself to a spot where you can be comfortable with overnight risk. I mean, how do you think investors make any money? They take it home with them overnight, over the weekend, for years. And some of them have substantial investments. So I don't think you have to worry so much about how much you're going to lose, because your fear and your greed really are reflected in the position size. I think the FOMO thing is more about pricing and when to get in and just acting out, buying things at the market, selling things at the market, right? That's more impulsive. That's where the impulsive part of the person might show up. Fear and greed show up right where we make our money, and that to me is in position sizing. So I think you can find a position size that would work for you. Just do it as an experiment. Buy $500 worth of whatever. Buy 2 shares of Netflix and see what it feels like. Because the point is to get into the behavioral part of it. The sizing and the scaling is the easy part, because that's the math. You can do it all in a notebook or on a computer, in a calculator, this and that. So learn, how to learn to turn your emotional intelligence to be an ally, not an antagonist. Because some of the things that you might have picked up from having heard other people say them doesn't actually suit you. But it's this Johnny Cochran logic where it's like, hey, if it doesn't fit, you must have quit. Like, well, there's no basis in law. It sounds good for the media. That's why, Shapiro had him say that. But karma came back to a name, and that whole defense team had catastrophic losses in their life. So, you got to be careful. You can say whatever you want as an aside, but the karma caught up with everybody. So challenge yourself, because The feelings that you don't want to feel are going to own you forever until you can somehow make friends with them. So think about what you don't like to feel in your trading. That's not going to go away. It doesn't go away until you learn to process your feelings, right? This is one of the great benefits of having been in the trading tribe, is that I learned that there is no feeling or emotion that I'm unwilling to feel. And that makes me powerful. You can do the same thing, but it's experiential. You can't theorize about it and be like, okay, yeah, I got this. It's like practicing music or jiu-jitsu or sex or anything like that. It's all experiential. So I'd say put the time in and see what you can do just as an experiment. Use real money, measure how you feel, because I think some of the fears that some of you might be feeling are unwarranted, and you're afraid of a boogeyman because you actually haven't gone through it yourself. Now, I will say this too, just to be fair. There had been times, and it happens so 36, 37 years, I've had 3 limit moves against me that were rather substantial. Now, for those of you who don't trade futures, a limit move is like what you might see in the stock market. It's kind of newer, where there's a daily band, the maximum amount it can go up or down before they stop trading, the market's halted. They've been around forever. And it started back in the day because there was no internet. There was basically no phones. You got to remember, the Chicago Board of Trade ideologically started in the early 1800s and then finally came about to be a physical place around 1850. And so when there were markets that were moving super fast, they would halt the market so that the data and the news can be disseminated, so that everyone can act perhaps more level-headed once everyone understood what was going on. It wasn't such a shock, to the system. So having had that happen, say, once every dozen years to me, it's still not enough of it. It's not so injurious that I have to stop trading or feel like, okay, never again, not doing that again. It's not, for me anyway, it wasn't that bad. Why? Well, because I don't put on my optimal position on the first day. I scale in. So if the market does turn against me, sometimes it jumps your stop the next day. That happens, but you make so much more money when you hold on to good risks that it pays for all those circumstances. Some of you might be a little uptight, right? And trading in so much fear that it stops you from actually making the money that you want to make because you have an irrational, I'm not a psychologist. I just play one on YouTube. The idea being is like, you might have an irrational or a bad expectation about what you think that means. Like, we're powerless over where the market goes. But again, if your position sizing is good, right, and you spend a lot of time, I spend an enormous amount of time analyzing, like, what's the optimal position size given the prevailing risk in the marketplace in volatility, mostly using ATR, understanding structure, understanding price action, but also knowing, like, the history of all the commodities, like, how do they run hot? How do they run cold? What are sideways markets, so that you can avoid suboptimal trades? And then certainly when you do add risk, you don't let them really define you at the end of the day. But again, losing money is part of the game. Like, you just want to make sure that they're all contained and that you have that big up red bar that shows where you get knocked out for break even or for paper cuts. Because then you're just like, whatever, little paper cuts, I don't care about those, because I know I have to be in the game for them to take off. Then sometimes, and again, on that histogram, there was maybe 60, 70 trades. They will run away from you for things that you can't fathom, for reasons that you can't fathom, that you can't understand until way after the fact. But if you adjust your protective stop each and every day, they will more than pay you for all the little paper haircuts, the paper cuts that you take along the way, and this and that. And then you learn to grow as a person. Then once you become comfortable, then you can scale, right? Because my belief is that if you're going to do this business, you really should put yourself in a spot where you can make an asymmetric rate of return, meaning 5-to-1 on any given trade, and then maybe a multiple or two of your account. it's a lot of hard work if you're going to get market like returns, right, as a trader, or if you can't outperform buy and hold, because then you're putting all this time in and you're not really getting paid for it. Now you are learning your craft, I'll give you that, but that doesn't mean that again, when you learn these, you do this when you're starting out, you develop these habits, right? So then you have to have it planned out ahead of time to say, okay, I might be trading this way with much tighter stops and doing my 2-for-1 trade, and I'm going to do that from say 5K up to 20K. But once I get to 20K, I'm going to start free rolling and trading bigger, right? To make my account balance go parabolic. Like that's what you want, right? You want to amplify your cash. This way, you give yourself more breathing room, because in the beginning, it's hard. Like imagine if you had 13K right now, like what are you going to do with that? How are you going to chop it up? It's 13. It's not, it's got two factors, 1 and 13. Like how do you even break that up? Do you say, okay, I'm going to leave 3,000 in cash. I'm going to chop up 10K, 2 lots of 5K, 4 lots of 2,500, 8 lots of 1,250. And that'll be my first risk unit, and then I'm going to add in my next one. Like there's just not enough money. And then what happens is you start looking at penny stocks or low price stocks, which at least back in the day when we had the pink sheets, that's where all the rumor and the conjecture was. Like that was all rumor mill stuff. Like there was no solid fundamentals. Like you were really risking like losing your entire position, or having the stock halted, or having them delisted. Like there was some serious issues there. So think about that and visualize, like for your own trading, what you want the shape of your histogram to look like. How many multiples of your R do you want on your best winners? Is it 10-to-1? And then what do you have to do to get there, right? I've tried to give you all the psychological and emotional tips that you can possibly use in order to get there, and then how to do it tactically. But ultimately, it's experiential, and you're going to have to put all this information into practice and do it that way. Anyway, if you want a free copy of the audiobook version of The Inner Voice of Trading, you can get it in the link below. You can also make a suggestion if you want to see a topic or inquire about education. Please like and subscribe, and I'll see you next time.